All right. Hopefully everybody's catching us now. Sorry about the technical difficulties. We are back. Tyler and I were just sitting here having our episode and our conversation, and I look up and the beautiful technology says go live. And I said, well, I'm pretty sure we are live. But you know what? Eff it. We're going live. We're doing it live. We're doing it live. If you haven't seen that clip, go back and look at it. It is wonderful. But Tyler is going to be our guest today. I'm going to not go back through everything that I talked about, other than say the fact that I'm visiting Tyler in Nashville next week. And Tyler, tell us, why am I coming to Nashville, man?
That is exactly right. So, first of all, excited to be here because, like I said, I have been, you have been on my show, I don't know, probably no fewer than 70 times.
Yep.
And it's always nice to return the favor. But hey, 30 days from now, you and I are having a mastermind get together. You and I run the brokers mastermind together. I've got the accelerator mastermind. We decided, hey, we want to run a really badass deal analysis workshop, 2 days, 2.5 days, technically. Let's combine both groups together. We've got over 50 people registered for it. It's going to be a lot of fun. So excited to host everybody here in Nashville. But Logan, as far as what we're seeing in Nashville, Nashville has been top 5 city for the Urban Land Institute for the last few years. For 3 years in a row, Nashville was number 1 on the Urban Land Institute's list of cities to watch. We just fell this past year. But hey, we're still in the top 5. We're still doing really hot. It's hard to maintain that number 1 spot. Nashville's still doing very well. It's really interesting. We're so insulated here. We're kind of in our own bubble. We were one of the last to enter the Great Recession. We were one of the first to come out of the Great Recession. We have a very well balanced group of industries here that keep us from experiencing a recession too heavily. And sorry to say the R word. I don't know that we're necessarily in a recession right now. I know some people are feeling like maybe we are, maybe we're headed towards one, maybe we're not. But you know what? It's never a bad thing to approach real estate as if you might be, right? Because those are good investment principles to live by regardless. So, look, Nashville's doing great. I'm in a 30,000 square foot office building that I bought in 2019, 40% occupied. So 60% vacant. It's 100% occupied today. It's doing very well. But 10 minutes down the road in downtown Nashville, there's buildings that are several 100,000 square feet that are completely vacant. So, it really is kind of hit or miss. Depends on specifically what you're looking at.
Yeah, most definitely. Well, what we're going to try to do today is help you guys to remember the future. Look, we're a month and a half into Q2 of 2025. Q1 was a wild ride, okay? There was so much that happened in Q1, but we're going to try to bring you some data and some facts for you to go and look at. If you haven't checked this out, this is our Q1 2025 CRE market analysis, national in Kansas City. I'm going to let Tyler kind of ping in here on some Nashville things. We like to call it Nash KC, all right? Nash KC. We're trying to bring these two cities together. It's two of my favorite cities in the country for sure. I always say, if I wasn't a Kansas City guy, I'd likely be in Nashville or somewhere, maybe in Texas, but it's a little hot in Texas. I like the seasons. I'm used to them. But I don't mind getting away from about November to March because, the weather is just not that great here in Kansas City. And man, I'll tell you what, I love the sun, right? And it's a little warmer down there. I do like some mountains and some good land as well. And I know that Tyler is the same because he was on his heavy machinery yesterday clearing acreage that I can't wait to go see and just maybe even get on some of that machinery whenever we get down there. But let's talk about commercial real estate, okay? So what happened in Q1 of 2025, right? I mean, our sales volume rebounded. There was about $75 billion of total commercial real estate. That's the volume is up 27% year over year. And that's across almost every single major asset class, right? So that's a huge bump. And what's been leading the charge? Multifamily. We talk a lot. We talk down on a lot of multifamily, and not from the standpoint of we don't believe in the asset class. However, the financial structures that have been put in place to purchase a lot of multifamily real estate is not there to last. And we're seeing those cracks, right? But it was still king with $30 billion in sales. That's 7% year over year increase, right? So, stable cap rates and, at 5.7%, confidence is rising on the multifamily side. A lot of talk on office, right? It's surprisingly resilient, $10.1 billion traded in office. Values are rebounding slightly, about $181 per square foot. If you're interested in office, shameless plug, we'll be bringing a 48,000 square foot office building to market here in the next week or two in a coveted South Kansas City submarket. So please do reach out to us if you have a thesis on the office side. I was listening to a podcast from the guys who sold Industrious to CBRE. Industrious, they have a Nashville location, maybe multiple. They have a Kansas City location. And what they do is they're going to go into an office building, take a floor or two or three, have some common area space. And it's not really a WeWork because you don't just get to float around. It's tied to private offices. And it's a really interesting business model, to be honest with you. So I'm actually trying to help some tenants kind of find some office space right now and highly, diving into this Industrious. But I do see some rebound and some interesting opportunities in the office side. Industrial stayed pretty strong, right? I mean, net lease cap rates stayed at 7.2%. The secondary markets, which we're going to talk about today, Nashville, Kansas City, they're performing well. Retail stayed strong as well. We saw 105% surge in volume year over year. That's $7.1 billion. So, people are really pouring back into the retail. Just from a capital markets standpoint at whole, right? Private capital and 1031 exchange buyers are back. I'm personally working on 3 to 4 1031 exchange clients right now trying to find their replacement properties. What does that tell me? Well, that bid-ask spreads are starting to narrow, right? So there are some more realistic seller expectations. You can't just find them. You got to be out there hunting for them. But they have been out there, and deals are starting to pencil. Tyler, what do you see in regards to, the best asset classes or the most, attractive asset classes in Nashville? Is it still multifamily similar here, kind of chasing the national trends?
I mean, look, multifamily in Nashville is always going to be a strong investment. It's going to have roller coaster moments, though. And I think that we're going through maybe a bit of a recovery on part of the roller coaster ride, right?
Yeah.
Multifamily went through a phase, especially in 2021, where when a lot of people were moving to Nashville, a bunch of developers, one, started building new construction, but two, started buying hotels and converting them into micro apartments. And we saw the market just get flooded in 22, 23, 24 with apartment units. And we had far more deliveries than our absorption rate could keep up with. And so, those guys were kind of bleeding out of their ears for a little bit. But I mean, the good news is Nashville is still a strong market. People are still moving to Nashville. So, when you look at deals like that, is it going to take you a little bit longer to lease them up? Sure. Are you going to have to give some rental concessions today? Sure. Is it going to be a strong asset in 3 years? Absolutely. Is it going to be an even stronger asset in 5? Of course. So I mean, if you're investing for the short term and expecting that everything's going to be rainbows and butterflies, I don't think it matters what asset class you're investing in, you're going to have problems. But if you're looking at these investments over the long term, right? If you've got a long horizon, you're going to be fine.
Yeah.
That's kind of how I feel about everything. I mean, look, office is very iffy. It's interesting. There are, I want to say the suburban office is doing well, but then there's pockets of suburban office where buildings are totally vacant and you don't know what they're going to sell for. There's, office buildings in downtown Nashville that are selling for 1/10 of what they sold for 5-7 years ago. So, but then, again, we've got this case study of an office building that I'm sitting in right now that's 100% occupied and everybody's doing great. It's really neighborhood by neighborhood. I mean, my focus is, and probably always will be, more on the neighborhoods. I like to invest on a micro level. I understand that better. And to me, I can get to know that area incredibly well, know exactly what drives those residents, why people are spending money in those pockets, what they need, and then I can go and deliver that. And that's why this office building does well. It's one of the largest office buildings in the neighborhood. There's almost no other office space.
Yeah,
So
absolutely, man. Well, I think that there's a couple things that kind of stand out to me there. Dr. Peter Lindemann always says if you have capital, you have courage, and you have a long-term horizon, you're likely going to win. It's hard to lose, right? And there's a lot to unpack in that statement, but this is something that I thought was really, really interesting. This is from BJ Feller. She's a broker on commercial real estate. I forget what market she's in, but I follow her on LinkedIn. She said this is a cycle defined by individual pipelines and localized execution, not broad sentiment. Whether your outlook is bullish or uncertain likely depends more on what's in your queue than what's in the headlines. And man, I saved that. I liked it. I'm reposting it. I'm texting it to myself because that couldn't be more true, right? And she was at the ICSC event here this week, and that was kind of the sentiment. Depending on who she was talking to, somebody was really uncertain or somebody was really bullish. And what you just said, which is I focus on neighborhoods. Real estate is hyper local. And this neighborhood's doing fantastic compared to that neighborhood. I know this neighborhood really well. I don't know what's going on in that neighborhood over there. We live in big cities, right? And so there's a lot of micro submarkets and different trends going on based off of that. And that's why it's so important to talk with somebody at the Cauble Group for Nashville Real Estate and somebody here at Midwest Commercial Real Estate on the Kansas City side, right? I think that's a really important to just remember. But we got our first question in, Tyler. So Katie sent me this question in. So interest rates seem to have stabilized a bit. Are you seeing that translate into more deal activity, or is capital still sitting on the sidelines? I'll let you take that, and then I'll give my 2 cents on that as well.
Yeah, it's a good question. I mean, I think in the last 30 days, in the last 2 weeks, has that made a difference? No. In the last 30 days, has it made a difference? No. I would say investor sentiment in the last 3 to 6 months has gotten substantially better, which I think is kind of funny because interest rates haven't gotten any better. And I would argue, yeah, the market's probably more shaky than it has been in a while. But, you look at it and really, I think we've just kind of come to realize like, hey, these interest rates aren't going anywhere. They're going to be where they are for a little bit. And so once you start to accept that new norm, right, we're kind of past the initial shock phase of, okay, are they going to come back? No, they're not. Okay, interest rates are now 7%. How do we sharpen our pencils and make deals work at 7% interest rates? Let's go and figure that out. It also takes sellers a little bit of time to understand that the prices that they thought that their properties were worth 12 to 18 months ago, that's not what they're worth anymore, or maybe 24 or 36, who knows, right? When interest rates go up, property values go down. That's just how it is, because unless you're paying cash, your cash flow is going to go down, which makes that property less valuable to you as a buyer.
Right.
And the market really determines the price. And so, I think we're getting to a point where, I don't necessarily think that sellers are desperate to sell. We're not seeing a lot of that yet, right? Keep in mind, we are 5 years out from the pandemic. Interest rates were negligible back then. You were basically being given free money at that point.
Yep.
But we're not seeing a lot of desperate sellers. We're not seeing foreclosures, which to me says, hey, there's a lot of capital on the sideline that's either scooping up these deals or coming in second position or first position or coming in as mezz debt. Who knows?
Absolutely. Yeah. Well, that's good insight. I want to pop back to Mark's slide on the multifamily side. So you can see here that rent growth nationally was modest at 1% year over year. Okay. That is because we had a huge number of deliveries in most major markets. All right. Well, Kansas City being what I'll call the outlier. All right. So Kansas City is leading the nation in year over year rent growth at 3.5%. So we're 250 basis points higher than the national average. That's obviously going to attract capital. Right. And so they're saying, hey, there's a need for apartments in our city. So when you ask me, is there more deal activity? Yes, there's more deal activity, and capital is starting to flow in to specific locations. Now, Kansas City at large is not attracting all of that capital. Certain submarkets inside of Kansas City in certain asset classes are. For example, the 1960s, the 1970s vintage multifamily product is out of favor with a lot of buyers. I mean, most of the folks I'm talking to, 1990s or newer, 50 plus units in a good submarket. Okay, well, there's only so many of those apartments. And so that is why we are starting to see a lot of developers kind of capitalize here, building new product type in Kansas City, which that brings a whole nother slew of challenges. And, with the capital markets with where they're at and the problems that they have trying to get their deals to make sense. I've been working on multiple multifamily developments with developers, and I see the pain. I see the pricing change on a daily basis because of tariffs or no tariffs or what the pricing is going to be. And that makes it really hard for you to make a $50 million decision when you don't know what the cost of your HVAC units are going to be, right? Like that's just one line item.
Logan, I want to add to that too. I mean, last year was arguably one of the worst years that we've seen for commercial real estate in a long time, right? Transaction volume was down. Nobody was getting loans for new development, new construction. I mean, a lot of those deals were on pause. Still a 1% increase year over year.
Yep.
You know what I mean? Like, it's all relative. I think that people get we get into these scenarios where it's like 2021, 22, 23, or part of 23. We had like these massive upticks in value and appreciation, and you get spoiled to it, right? But like, hey, even Nashville in the Great Recession, at the bottom of the trough of the Great Recession, Nashville real estate still appreciated by 1% year over year.
Yeah.
So
definitely. We got a couple other questions that I think are really valuable here and really good insights. Number one is, hey, which buyer profile is most active right now? Is it private investors? Is it institutional investors? Is it family offices? And, I would say, like, for me, at least, I'm working on a lot of the private investor side. I don't really do a ton of work with institutions or family offices, but people are starting to reach out, in Kansas City. Nashville's probably a little bit different. That market's likely on a lot more of these institutional level, quality investments. But I am getting larger groups to reach out saying, hey, we are interested in evaluating Kansas City. And this would be either land buyers or this is developers looking for land to kind of to figure out what they're going to build and where they're going to build it. More and more of those conversations I'm having with groups that are large at scale and from a nationwide standpoint that are starting to kind of call me and start to have conversations, but they're really just kind of tipping their toe in the water. Really, most of the transactions that I'm seeing get done are with private investor groups, and whether that be a 1031 exchange or potentially a private equity group that is interested in continuing to expand their footprint. Family offices, they're always going to be active, but family offices, they don't really have to do anything. They don't have necessarily an investment mandate that they have capital that they have to outlay, right? So they're playing, I think, mostly on the debt side right now. This shadow lending secondary market on the debt side has been a big game. I mean, we've seen Oaktree get into it. Blackstone's obviously into it. A lot of these big companies are starting to kind of get into the debt side of the game and saying, hey, look, you need some real estate debt. We're not governed by the same, financial and or regulatory environments that your traditional banks are. And so we can come in and lend. Now, our interest rate is going to be quite a bit higher. Our provisions on taking that asset back are going to be a little bit higher. And, frankly, we have an asset management team and we can ingest that property pretty quickly. So you better make your payments. So anyways, that's where I'm seeing a lot of these family offices kind of play in, is this secondary debt market. Are you seeing similar things there in Nashville, or institutions really starting to pop off?
Yeah, I mean, I think a lot of family offices right now are honestly, they're considering alternative assets to commercial real estate, which I think is interesting. If you've got a lot of cash, why aren't you looking at treasury bills? And that's one thing that we're having to sell against a lot right now, which I get. If you're able to get 4 or 5% on a T-bill, it's hard to say 6 or 7% on commercial real estate if you've actually got to be involved and you've got to take a little bit of risk. And family offices are very risk averse. They say, well, I could buy a T-bill for 5% and do nothing.
Yeah.
Well, okay, I get that. So, oftentimes it comes down to the education, comes down to the risk appetite. We don't deal a lot with institutional capital. I deal a lot with, consulting the family offices on basically portfolio construction, how to really structure what their portfolio is going to look like in order to, one, maintain the stability of what they've got going on, but two, keep the cash flow coming in so they can whole live off of it, right?
Yep.
And so depending on the market cycles, they have very different needs. But largely, it's mostly private investors that we work with, especially. And so a lot of the transactions that we're seeing right now are all across the board. I mean, I think you'd be surprised. It has nothing to do with it. I mean, I'm not a big multifamily guy. I really haven't been since probably 2018. So we don't really do a lot of those transactions. I get calls on it still. So, I send that out to, we've got Jake Clark is in the brokers mastermind here in Nashville. I send him all of our multifamily leads.
Absolutely.
And he's already gotten 2 of them closed, which is pretty great. So he's still closing deals. We do a lot of industrial, office retail. We're not closing a lot of office, but Emily, one of my brokers, is working with a 15,000 square foot office user right now that's looking to buy. So it's like, people are still out there doing transactions, whether the world, is in a recession or not, people still want their business to be somewhere. So there are still transactions that have to happen.
Yeah, most definitely. Another great question coming in. Hey, are there any property types that are bucking the national absorption and vacancy trends, either outperforming or lagging? Well, I can tell you this is a graph from the different, the 4 main food groups in Kansas City specifically, right? So if we look at the big, slice of the pie here, that's going to be office at 18.6%. That's the number one, asset class in regards to a vacancy standpoint. Industrial in Kansas City, 4.3%, right? So that's very strong. Check this out though. Smallest piece of the pie is retail. Our vacancy rate is at 4%. And then multifamily comes in just above that at 5.2%. So these 3 food groups, industrial at 4.3, retail at 4, and multifamily at 5.2, still really, performing at a strong level. Office is not dead. Office is being reinvented, and it's happening on a local basis, and it's happening in a neighborhood basis, just like Tyler mentioned before. So hopefully that gives you a little bit of insight in regards to any property types that are kind of bucking the national absorption, at least here in Kansas City. I would imagine that Nashville's probably pretty dang close to this in regards to that. Office probably a little lower on the vacancy side, I would imagine. But, 18 to 15 to 20% is kind of where I think most of the markets are in regards to office. Now, we'll see. I know my wife, for example, my wife is now mandated to go back to the office 3 days a week, and so she is at the office 3 days a week. Well, that is the largest marketing and advertising holding company, WPP, in the world, not just the country, in the world. They own, they own Ogilvy in New York City. They own all of these marketing and advertising. That was a company-wide mandate that you come back to the office 3 days out of the week. Look, they do work that is really important to be collaborative next to each other. It's creative. It's copywriting. It's, and she's holed up on Teams calls all day long at home. And it's really easy when she goes to the office to be able to get stuff done and not have to jump on a Microsoft Teams call. So I think that works for some of those industries. For Tyler and myself, look, we're out in the field on a regular basis. We're out looking at properties, touring properties, meeting with people. We don't necessarily need to be in the office on a regular basis. The brokers that I work with, they're here once a week. They're flexible, right? And so every user is going to have a little bit of a different need there. Thoughts on that?
Well, I was just going to say, look, even with that, I'm in a 1,600 square foot office suite right now because I need a studio space. I have to have a space for me to be able to go and record and have it all set up at all times, have it be quiet so that I can come in and record a couple days a week, right? I'm not going to set this up in my house because I'm just not going to get the quality of internet there. I'm not going to get the quiet. Some people might, right? I get that, whatever. But then at the same time, I like for my brokers to be able to have space. So yeah, even though maybe we don't need the space more than a few times a week, I'm still going to have space for them to go to, right? I also have a property management company. They need a place to go. So, I think office space isn't going anywhere. And look, I'm a millennial. Maybe I'm on the dinosaur side of this. I really don't see how remote work 100% of the time for all companies is remotely feasible or even remotely healthy for companies sustainably in the long term. we've proven that it can work, especially in the short term. Maybe it can make your weeks, a little more flexible here and there. 3 days in the office, 2 out of office, great, right? But as a 100% permanent solution, all that does is commoditize your 40-hour work week. So if you're a bookkeeper and you're working from home now because you don't have to ever go into the office, you're not competing with another bookkeeper that's down the street. You're competing against a bookkeeper that will take half or a quarter of the wage that you will in the Philippines.
Yep.
So you got to be really careful about that. I know a lot of people want to, say, oh, well, I am more productive when I work from home. I doubt you actually are. I highly doubt that you actually are. And, the synergy that you get from being in the office is unparalleled.
Yeah, I couldn't agree more with that. With that being said, shifting gears just a little bit, Derek Barton is asking, hey, do you guys do any mobile home parks? Look, Derek, I get mobile home parks sent to me on a regular basis. That is not that is not my skill set. And so I've got some partners that I just kind of send those projects to evaluate those, right? Some operators that I may know and some more, brokers that operate in that space. I have not personally ever invested in any mobile home parks. I have been a part of a few of those transactions, so I can speak to those at a very high level. But I know, Tyler, you've been involved with some mobile home parks in the past, and a lot of folks in our mastermind group are as well. This is a hot asset class that I didn't really cover. It's one of the number one topics of most talking points in real estate is how do we get attainable housing? Well, this is one way, but lots of NIMBYism in regards to having a mobile home park either being developed in your neighborhood or around your neighborhood. And so it is limited by a lot of this, what I'll call grandfathered zoning in, right? And so if you're not zoned for a mobile home park already, it's sort of difficult to go find a new site in a desirable location to put a mobile home park on. Tyler, what are your thoughts?
Yeah, there's a lot of stuff that I like about mobile homes, right? That's one of them. It's very difficult to go to a municipality and get a piece of property rezoned for 20, 40, 50, 100 mobile homes today, right? So going out and being able to buy one, you already know what all of your competition for the future is probably going to be. On the flip side, though, and I've underwritten a lot of these deals, they're tough to make work sometimes. One, generally, they're not as institutionalized or at least not as professionalized as a lot of the other investment classes from a seller standpoint. Some of the documentation that I have gotten from sellers makes you wonder if they have anything with regards to financials on these properties.
Right.
And not that that's always a bad thing, but it just gives you a little bit of pause to say, all right, I'm willing to take a little bit of risk here to figure out the value add upside. Am I willing to take the risk that what the seller is telling me isn't necessarily true with regards to how much income is coming in on a mobile home park, right? And so that's where I start to shy away. And for those reasons, I haven't bought one. Yes, they can have some pretty attractive cap rates, but this is what I tell our students all the time. If that seller could get anything lower on a cap rate basis for that property, they would be. There's no reason they can't.
That's exactly right. That's well said, Derek. On the other flip side, I would say what I have been starting to see is kind of workarounds. And what I mean by that is I'm looking out of my office window right now at a storage container. And there are manufacturers. There's a manufacturer of homes out of storage containers an hour south of Kansas City in Butler, Missouri, that can deliver you a 3-bedroom, 2-bath home for $199,000 that you set and stitch on site. You put some aesthetics on the outside of it, and it looks incredible. And it is wild. So you pair that with modular construction. And if modular construction can really start to bring price points down and the deliverability of those, and general contractors really start to figure out how to set and stitch these on site, I think that could be the conclusion to that. So mobile home parks, I don't think are going anywhere. I think developers and builders are figuring out creative ways through storage containers, which is a true home that you set and stitch, or modular construction to try to bring price points down. And I'm really excited about that part of our industry because you think about, 3D homes being built and these homes that could be potentially built on site for a very reasonable price. You may be able to get that zoned. So as long as the architectural design looks similar to the homes in the area, and you don't have really a mobile home park necessarily, but you may have a subdivision of 30, 40 homes that were set and stitched through storage containers in a subdivision that you can get passed by a planning and zoning commission. So keep your eyes on that trend. I think that's a really interesting one. Okay, well, look, I mean, we want to keep this pretty short. However, we've got some conclusions. Let me get this up on the screen for you guys so you can review this. But I want to just kind of wrap this up because we got 5 or 6 more questions that I definitely want to get to. But my top 3 insights from Q1 of 2025 is that commercial real estate is rebounding. Cap rates have somewhat stabilized. Transaction volume is fundamental, and it is up, right? Secondary markets like Kansas City, like Nashville, are outperforming different markets. Why? Well, supply and demand and affordability. Private capital is driving the momentum, at least in my market, and institutions are still slow to re-enter. I think they're trying to figure out their balance sheets, figure out their investment mandates, and they're pouring a lot of money into that shadow capital, shadow lending side of the business. My projections for 2025, I think volume is going to continue to climb as that bid-ask spread continues to narrow, right? There's continued resilience in certain pockets of multifamily. We've already shown you the resilience in industrial and in the retail side of things. Obviously, office is reinventing itself. It's figuring itself out, right? People are starting to go back to the office. You're not going to be at home. I'm just going to say it right now. I don't think you're going to be at home working 5 days a week anymore. I think businesses are starting to tighten up and saying, no, you can't go get your nails done and take a Teams meeting at 12 o'clock or at 1 o'clock in the afternoon. I need you here so I can manage my workforce, right? And so I think those are things that you should think about. And I think 2025 has a positive outlook. Anything you would add to that, Tyler, before we get to some more of these questions, because they're just rolling in, man.
Yeah, man. The only thing that I would add to that you didn't cover is pay attention to tertiary markets. You said secondary is starting to perform incredibly well. One thing that I'm getting more and more curious about, and we used to stay away from this, right? You used to be like, oh, tertiary markets, who knows what's going on there? It's kind of scary. They're small. There's a lot of risk. I think to a certain, I mean, of course, is Chattanooga, Tennessee going to be riskier than New York City? Yeah, obviously. But come on. The opportunities that you're going to find in a market like a Chattanooga, in a market like Birmingham or Huntsville or Louisville, some of these smaller markets are really, really interesting to me. I mean, take Chattanooga, for example, and I'm using that obviously because it's 2 hours away from me. I own some properties out there, and I just know it really well because we're investing in it. But from Chattanooga, it's a 2-hour drive to Nashville, Atlanta, Knoxville, Huntsville, the Carolinas. It's growing rapidly. It's a great little town. It's got the best internet in the country. So, things like that. It's like, okay, well, I mean, if we are going to move, if you're sitting there going, no, office is dead, we're 100% moving to a remote work environment. Well, Chattanooga is going to crush it because the tax advantage of living in Tennessee with no state income tax and the outdoors and the best internet in the world, little towns like that are going to blow up and crush it. So pay attention to tertiary markets. I think there's something to learn. And look, as a smaller investor, sub $5 million on the investment side, way more approachable.
Absolutely. That's really well said. I always tell people that you can get to 80% of the continental US from Kansas City in a 2-day drive. All right. So that is why it's a logistical hub in the United States. It's middle America. We've got rail, we've got trucks, we've got agriculture, similar to Nashville. You got a lot of land to deal with, and it's where just stuff moves through. It keeps the country moving, right? And so I love markets like that, like Chattanooga. I have a lot of submarkets just in an hour or 2 hours, drive from Kansas City that I do a lot of business in. Think about Wichita or Topeka, Kansas. On the other side, you got Columbia, Missouri, right? So there's a lot of different markets like that. Jake Zinn, my man Jake, is saying that's wild. I think he was talking about, probably the the content around the homes and storage containers and the modular. It's definitely something to keep your eye on. Jake. Randy comes in and says, hey, I have to disagree. Hey, we love that, Randy. Let's talk about it, right? Mobile home parks, which have mostly tenant demand or owned homes, can create a situation where each owner is incentivized by owning their own trailer and still save money in comparison to the alternatives. Tiny homes offer savings, but older people have too much stuff to consider those as a solution. Hey, I appreciate that, Randy. I don't think that what I was presenting as a solution to all of the different components, but I'll tell you that I am working on a subdivision here in Kansas City in a really, really great submarket where everybody wants to live. And it is really difficult, and it's for sale, right? This is not for rent product. I am trying to bring for sale product for the first-time home buyer. I have to realize as a developer that I can't solve for the fact that once that person buys that home and they resell it in a year or 2 years for $300,000 more, I can't solve that, right? I can only solve for that entry-level home price. So I understand it was very clear, Randy. I get that component of that, and it doesn't fit for everyone, but I do think there's going to be alternative solutions that people can own a home if it's attainable. And I'm talking about $300,000 to $400,000 here in very good submarkets in Kansas City. I'm not talking about bad school districts or crime areas. This would be, in coveted areas. If I can deliver a 1,600 square foot, 3-bed, 2-bath home for $300,000 in that area, one, I know they're going to fly off the shelf. But two, I know that's going to create some opportunities. And my hope is to be able to not only just do that once, but replicate that process and actually figure out how to work with municipalities to say, hey, we need to joint venture on how we get the infrastructure put in place so that we can keep these homes attainable for those folks. But I appreciate that, Randy, very much. I appreciate you disagreeing. Tyler, any thoughts on that? I'll bring it back up just so you can see what he was talking about here.
No, I mean, look, the only thing that I have to say is, isn't it crazy that nowadays 300 to 400,000 is attainable? Because it is, right? Like, I remember when I first got started I remember back in my day, homes in Nashville, the median price was like $225,000 to $250,000, right? And that was only like 10 years ago. That was 12 years ago. And the median house in Nashville now is over $550,000. It has doubled since I got into real estate. Isn't that crazy? Like, just in the last barely over 10 years, the median home price alone has doubled.
Yeah.
Food for thought.
There was a stat the other day that the median age of a home buyer used to be 28 years old. Do you know what it is now, Tyler?
Yeah, probably 47.
It's 40 years old.
Is it really? Wow.
Years old. And that is a 10-year difference. 10 years ago, the first home buyer age was 28 years old. Now it is 40. So absolutely understand. Randy kind of followed up, said, hey, the standard in my area is about $100,000 per bedroom. Yep. I mean, I think that's a good marker to put that at. And that prices so many folks out, right? I mean, it absolutely does. We need to do something about it. It is going to happen on a localized level. It takes the work with municipalities and with the developers to understand that we don't just need more rentals. We need to get housing in people's hands that they can own for a period of time. I will give my home state, Missouri, some really good credit in regards to helping people out with that. They have a first-time home buyer credit that you don't have to bring any money down to buy your first home. And I think that is a phenomenal, tool for folks to be able to get in there, because that down payment does keep a lot of people out of the industry. And there are some staggering statistics in regards to folks who own homes versus they rent their whole lives, and in the actual net worth of those individuals. When they've tracked that over the last 25 years, it's staggering. It's about 400% difference. And I am here to say, and I've said this multiple times, that I believe, and my belief, I know Tyler shares this sentiment, is that you should be able to have a safe place to live that you can afford. If you are a police officer, if you are a teacher, if you are a manufacturer worker, if you are somebody who is keeping the American dream and moving, so we can sit here and talk about those things, right? Like you are out there doing that work, you deserve an opportunity to live in a safe place and own a piece of a home and be able to build some net worth for yourself. So anyways, I'm getting the goosebumps just talking about it. It's something I'm very passionate about, and hopefully other people can kind of hear that and figure out how to work with their local governments and their planning and zoning commissions. It takes a lot of meetings. It takes a lot of time. It takes a lot of work to kind of get this created. But I have a big passion on figuring out how to create task forces across the United States that have these initiatives, and they're going out and having those conversations with those municipalities. But we're here talking about just, commercial real estate transactions and volumes here, not necessarily solving the world's problem in regards to attainable housing. But we probably got time for a few more of these questions. This is a great one. It said, "Hey, how are you sourcing your best deals right now?" Well, I appreciate that, and I'm going to give my 2 cents. First and foremost, I have to anchor with realistic expectations. Any conversation that I have, I know you may have John down the street who said your property is worth this, or the estimate says that, or Bob sold his property for this, but each deal is specific. Each deal. And so I do not give any pricing guarantees or averages or anything until I start to understand that specific property. I'm looking at properties like products, okay? Like products. Like that's what we have to look at. When was it built? What benefits does it have? What features does it have? Does it need to be upgraded? Does it need a software upgrade, right? It's a product. And so your product that you own is different than John's down the street or Carol's down the street or Karen's down the street that they own, because they may have done something different to that product, right? So that is very important to keep in mind. So the way that I'm sourcing the best deals is filtering out with realistic expectations as soon as I possibly can in the conversation. If it's not in the ballpark, I just gracefully say, you know what? I understand that you believe that there's a value here that the market isn't going to. You may just need to hold on to your property for a little bit longer, put them back in the queue, keep reaching out, keep making contact. But that's my number one tip right now, is try to get some realistic expectations based off of market data that has recently traded. We are in a rapidly evolving market where prices that were 3 months ago, 6 months ago, 9 months ago, they are changing. The data doesn't show up until May 22nd in Q2. We get to look at what happened in Q1, right? And so we have a lagging industry. So you need real-time data that is informing your decisions. That's how I'll put that, and just leave it for you, Tyler.
I mean, I think you well covered it, man. I mean, look, the best way to find deals today is to just scream it from the rooftops. Let everybody know what you're looking for and go out there and hunt it down. I mean, look, I'm a big believer in making sure that you've got fishing lines everywhere, right? And you've heard me use this metaphor before. But look, we as especially if you come from a sales background, you're so used to hunting, right? And I love hunting. Don't get me wrong. But when you go out and you hunt, what happens if you don't see anything that day? There's nothing for you to come back home to.
That's
You're
right.
going to be hungry. What I like to do is set up a whole bunch of fishing lines and then go hunting. That way, when I come back, hopefully I've got something on the fishing line. And all of my different fishing lines can be something else, right? One could be an Instagram post. One could be a LinkedIn post. One could be a YouTube video. One could be a blog post. One could be an email. One could be a text, whatever it is, right? There's so many different ways for me to come back and find other deals. I mean, I bought a $1.8 million 9-story office tower in downtown Chattanooga off of an Instagram post, because I just said I was going to Chattanooga and wanted to buy something.
Yeah.
That was off market. All right. I bought a $435,000 retail building that I flipped for $650,000 after signing a lease off of a letter that I sent during the pandemic.
Yep.
There's so many different ways. And of course, I've bought stuff off of LoopNet that everybody was looking at like, that's not worth anything, because they were looking at it as a car wash and I was looking at it as a restaurant, right? Well, yeah, obviously that's kind of a ridiculous example, but how can you look at something that's on the market and completely reframe it in a different way that nobody else is thinking of? Because then something that seems overpriced might actually be a pretty damn good deal.
Oh, yeah.
That's how to look at it.
Absolutely. Another example would be change of use or change of zoning. I mean, it is, if you want to go back, go find some information about Ricardo's law of economic rent. Look, the value of land is not necessarily derived from what the capital or effort that's been put into it. It's derived from the scarcity and from its production capacity. And so if infrastructure like sewers goes down a street next to farmland, that farmland just went from 50 cents per square foot to $1.50 to $2 per square foot because sewers are now there and something can be built on there. So keep that in mind as you're looking at deals. We've got one last question. I got to show it. Hey, this is single family homes are struggling hard right outside of Austin, Texas. Some homes have been taking over $150,000 price cut and they're still sitting on the market. Do we have any insights on why this market is different compared to the rest of the United States? Well, LinkedIn user, I would say yes. Go read Am I Being Too Subtle by Sam Zell. It will tell you exactly what has happened outside of Austin, Texas, outside of Phoenix, Arizona, some parts of the Southeast, right? There are certain areas, well, when I say Southeast, I mean Florida, basically, that there was a number of, thousands of units that came on the market. Well, what happened at that same time? Well, interest rates have stayed above 7%. Every single basis point on an interest rate prices out another 10,000 people on the way that they can buy that deal. So if the interest rate goes from 7 to 7.1%, there goes 10,000 people. They can't get the house. I would imagine what happened in Austin is similar to what happened in Florida. Developers saw big trends. People are moving here. Let's go buy land. Debt is cheap right now. It takes 2 to 3 years to get those deals done. They all came online, and now everybody else is priced out of the market because we went through the fastest rate hike in history from, basically free money to 7%, and that priced out a lot of the individuals that could buy that. So that would be my 2 cents on why that's sitting on there. And we are not just commercial real estate guys. We know the residential market because one thing I always say is where rooftops grow, commerce flows, my friend. All right. Anyways, thank you guys so much for all of the questions. I knew this was going to be a popular episode. We probably got 15 other questions. Tyler is a busy guy, though. We got a lot we'll bring him back on. Make sure if you do have other questions, send them to myself, send them to Tyler, Sophia on his team, Katie on my team. We'll get your questions answered. We'll make a LinkedIn post about it. We'll make a YouTube video about it, or maybe we'll cover it on Tyler's Investors Roundtable, which we do every 2 weeks on his show, and we stream that live as well. So make sure to check out and follow Tyler on social media. Tyler, where can people get in touch with you if they want to learn more about Nashville, Chattanooga, adaptive reuse projects? Because there was a question specifically detailed for you here. I want to hear about adaptive reuse. Where can they reach out to you at, man?
Yeah, best thing to do is to send me a carrier pigeon at 123 Main Street. No, look, YouTube is by far the best, by far. So at Tyler Cauble, just go out there. We've got like over 600 videos on commercial real estate.
Yes.
If you're watching this on LinkedIn, connect with me. Happy to connect. Every now and then, I tend to hop on LinkedIn occasionally, not nearly as much as Logan, but on once in a blue moon, and I'll share something. So.
Please. Just go look at the content Tyler, myself, other people have put out. I get a lot of people reaching out. I know Tyler does way more than me. Hey, can you talk to me about X or Y or Z? And I would just go to his LinkedIn page and search a video on that. And I guarantee he's got a highly produced, beautiful video talking exactly about that one topic. Go watch that piece of content. Then say, hey, I watched this. Here's 3 questions that I had that I wanted to talk through, or something along those lines, right? There's a lot of people out there that just want to blanket reach out. That's fine, but if you go watch some of the content that Tyler's put out, that I've put out, we've got over 20 of these episodes now live on LinkedIn. It's all free. Go get informed, right? Go get informed, see what we're talking about, see the content that we're putting out. Then maybe reach out and say, hey, look, I watched this and this is what's gotten me to get on a phone call, Tyler. I'm sorry. I know we got to go, but somebody said, Logan, I watched that LinkedIn live at minute 21:37. You said this, and I had a follow-up question. I answered that, right? But the 15 other DMs in my LinkedIn, because I'm not on YouTube like Tyler is, but on LinkedIn, it was, I'd like to pick your brain about commercial real estate. I don't know what that means. Like, what do you want to pick my brain about? Right. So if you're young and you're new to the industry and you're trying to learn and you would like to get Tyler's ear or my ear or somebody else in the industry, go watch some content, engage with them, be specific in your reach out, do some research, show that initiative, and I guarantee you get a response. So with that, I'm going to leave it. Tyler, thanks again for joining this episode of the Kansas City Commercial Real Estate Market Pulse. We'll be back, I'm sure, next week with another episode. Follow Tyler on YouTube and myself here on LinkedIn. Thanks for joining, and I really appreciate all your questions. We'll see you next time.